Hello and welcome to a cmsfx daily video recap. I'm your fundamental market analyst, Nick Nassad. Today is Thursday, September 9th, 2010. Let's begin with some US data, as it helped to give a lift to general risk sentiment in today's trading. First up, jobless claims fell for a second week in a row for the week ending September 4th. First-time claims for unemployment benefits fell by 27,000 to 451,000, the lowest level since July and the second lowest level since May, helping to arrest a rise in claims during most of August. With companies in the US unable to squeeze out further productivity gains from their current workforce, as we saw second quarter labor productivity decline, it could mean that companies may begin hiring in the fourth quarter. However, that would be predicated on consumers feeling more optimistic, which would ensure more demand. However, it's a bit of a chicken or the egg situation in that for consumers to feel more confident, the economy needs to see more job growth. August non-farm employment report, the monthly jobs report, did paint a slightly better picture about the US labor market, and today's data could help to ease some of the more pessimistic concerns out there in regards to the US economy reverting back to recession. In a second positive release, the U.S. trade balance in July surprised forecasts on the upside as the trade gap narrowed to $42.8 billion from June's $49.8 billion. That had been a 19-month high for the trade deficit. The factor that had caused June's weak report, which was falling exports and rising imports, were reversed in July's report, as exports rose 1.8%, about the same amount they fell in June, while imports declined 2.1%, following a 3% increase in June. Exports were helped by a surge in capital goods, including a large order of commercial planes. An increase in exports and a concurrent decline in imports will go a long way to help U.S. growth. Trade flows have been a major drag on the U.S. recovery after providing support for the economy during the recession. Net exports subtracted 3.4 percentage points from growth in the second quarter, when U.S. GDP expanded at a 1.6% pace. The U.S. news helped U.S. stocks to jump out to a very strong gain, and as I mentioned, boosted risk appetite for growth-based currencies like the Canadian and Australian dollars. The Canadian dollar extended its gains it had yesterday following the Bank of Canada interest rate decision, which raised rates to 1%, and we had seen it come to support around the 1.0350 area towards the end of yesterday's session, and today we see the pair pushing further down to the 1.03 area, shy of our next real level of support coming at 1.0250. We do have employment data coming out for Canada in tomorrow's session, so if that is a positive release, we should be able to reach this 1.0250 level in tomorrow's trading. Taking a look at the Australian dollar versus the US dollar, we see that it broke a level of important resistance at around the 0.92 level. First, we had a move higher in overnight trading following a strong Australian employment report, and we reached a high in New York trading around 0.9275, which was a 4-month high for the pair. The pair then eased somewhat as US stocks gave up some of their loftier initial gains. While the RBA did hold rates steady for the 4th straight month in yesterday's session, citing concerns about the health of the U.S. economy, signs from Australia itself point to a strong recovery, which should benefit the Aussie going forward. A sign of that was the August jobs report, which I had mentioned. The Australian economy added 31,000 new jobs, better than expectations, and the unemployment rate fell down to 5.1%, also better than expected. Continuing job gains will help to keep up domestic demand, which expanded at its strongest pace in 2 years in the second quarter. The Australian economy overall grew a better than expected 1.2% during the second quarter compared to the first, as strong demand from China for Australian iron ore and coal powers the export sector. The strong export sector has then fueled a jobs boom, which is now being felt in consumer demand. Now let's turn to the UK, where we had the Bank of England keep the benchmark interest rate at 0.5% and held its target for bond holdings at £200 billion, as was widely forecast. The UK does not provide a detailed statement with its decision, so we will have to wait until Bank of England meeting minutes come out on the 22nd of September to find out the deliberations behind the scenes. Still, the pound was pressured prior to the release against its major rivals, as traders and investors see a bank more focused on trying to sustain the country's economic recovery than battling inflation, which has remained above 3%. UK GDP grew a surprisingly strong 1.2% in the second quarter, but that surge is likely to cool and has already showed signs of slowing as August PMI data on manufacturing, services, and construction all eased, and all came in weaker than expected. In other words, more may need to be done by the Bank of England, and if another round of monetary easing is at hand, then that would spell weakness for the pound going forward. The UK also posted its trade data, which showed the deficit in goods widening to a record in July. The visible trade deficit, or the trade gap in goods only, widened to £8.7 billion from £7.5 billion in June. The gap was much wider than predicted and came about as imports jumped 3.1% while exports declined 0.9%. The rise in imports shows that there may be some increase in domestic demand. However, higher imports work against GDP growth. Imports were pushed up mainly, though, by a higher oil bill. The trade news could be interpreted as a blow because it shows that a weaker pound is not necessarily translated into higher exports, a hope that the Bank of England had that would be able to help boost the country's recovery. Tough government spending cuts announced to help trim the deficit will work to crimp demand, and the Bank of England was hoping for stronger export growth to help offset some of that decline in GDP. So far, however, that does not seem to have materialized. Taking a look at the pound-dollar pair, we see that it had slid overnight, reaching a low of 1.5374 following its trade data, then managed to rebound a bit in New York trading on the back of higher stocks in the US, but it met resistance at 1.5476 and fell back down again. The pair has therefore, for the most part, been stuck in a bit of a sideways trading pattern during the last 2 weeks, after it had declined to start the month of August. So we'll see if this move lower in the pound continues, with the next level of support coming perhaps at 1.52, which had been an old level of resistance back in early July. Also today, comments from Deputy Prime Minister Nick Clegg, who said that the UK recovery will probably be choppy and uneven, work to pressure the pound. Taking a look at the euro-dollar, we see that for a second straight session, we remain between this trading range of 1.2650 and 1.2760. So just sideways movement, consolidation following a very steep decline in Tuesday's session on the back of worries about the Eurozone financial sector. We have this upward sloping level of support here as well, which we adhere to in today's trading. The US dollar Japanese yen pair, meanwhile, fell overnight, tested the area around 83.50, and then rebounded in New York trading, though it didn't rally that far and kept to this new downward sloping level of resistance, which is also our 100 period moving average in the 1 hour time frame. Overall, the pair has been drifting downward over the past few weeks, but Japan's finance minister kept the threat of yen selling intervention alive Thursday, saying the authorities are conducting various simulations to curb the currency's strength. Right now, however, intervention might be unlikely as long as yen gains are orderly and in the absence of a sharp risk sell-off. And that will do it for today's market highlights and fundamental news, and let's take a look at tomorrow's fundamental docket. Coming up tonight, New Zealand posts a measure of international trade, while Japan posts its BOJ meeting minutes, its final version of GDP, as well as a measure of inflation. Overnight, we get trade data from China, producer prices from the UK, as well as the UK Conference Board leading index. Tomorrow, early at 7 a.m., Canada posts its employment change, and the U.S. releases its wholesale inventories before we get a speech by Bank of Canada Governor Carney. At 10 p.m., so after the markets close and Friday's session, we get a slew of reports from China, including consumer and producer prices, industrial production, fixed asset investment, and retail sales. So that may have an impact on how currencies move